In this video, I'm going to share my insights on Coca-Cola's latest annual results to demonstrate how analysts review results, the key metrics that they focus on, and how they impact on a company's share price. In early March, the annual results season comes to an end, and this is a critical time for analysts, as the publication of results gives them lots of data to analyse and allows them to update their valuation models. Before we dive in, my name is Deborah Taylor and I'm a trainer at Financial Edge. Before this, I worked as a director at Barclays and spent nearly 10 years in investment banking. Having been through several results cycles as an analyst, I know how challenging results analysis can be. But don't worry, as by the end of this video, you'll be a pro at this. If you're considering a career in finance or even preparing for interviews for finance roles, this video is essential viewing. What's in a set of results? Lots of companies publish their annual results during February or early March, and this usually includes a short press release of summarised financial data, followed by a more detailed set of financial statements. As the press release is published first, this is what analysts and investors will focus on, and it'll also have the greatest impact on a company's share price. Now, although an analyst will skim through the whole press release, it's not really designed to be read like a book. We usually focus most of our attention on the first few pages and then dip into the rest to find out more detail. In case you want to look at Coca-Cola's full press release that we'll be analysing in today's video, we've popped a link to the filing in the description below. The very first metric that we analyse is revenue growth, and this tells us the percentage change in revenues since the previous year. This is absolutely critical as it helps us to understand how quickly the business is growing. If we compare it to other companies, we can see how well the business is doing compared to its competitors. Now we can see that Coca-Cola's revenues grew by 3% during the whole of 2024. But is this good or bad? Well, during the same period, Coca-Cola's main competitor, PepsiCo, had revenue growth of just 0.4%. So Coca-Cola's revenue growth does sound quite good. However, in reality, this comparison is too simplistic. We need to understand what is driving revenue growth to take a view on Coca-Cola. So let's take a look at what revenue growth drivers are. Revenue growth for a company like Coca-Cola can be broken down into 4 components, which we refer to as revenue drivers. These are volume growth, price growth, currency effects, and acquisitions and disposals. To make this easier to understand, let's think of Coca-Cola as an apple farmer who runs an orchard and sells apples in different markets. Each of the revenue drivers is a different way for the farmer to increase their income. The first driver is volume growth, which is where the company sells more product than the previous year. Think of a farmer who harvested 1,000 apples last year. This year, they've improved their farming techniques and grew 1,200 apples. Even if they sell each apple at the same price, they earn more simply because they have more apples to sell. For Coca-Cola, this is like selling more bottles of soda. More sales mean more revenue. The second driver of revenue growth is price growth, which happens when the company increases their prices compared to the previous year. Going back to our farmer, let's say that they still harvest 1,000 apples, but instead of selling them for $1 each, they raise the price to $1.20 per apple. Now they make more money without growing more apples. Similarly, Coca-Cola can increase its prices to boost revenue. However, just like with apples, if the prices get too high, some customers may buy fewer drinks, meaning the price increase could be offset by lower volumes. Analysts often combine volume growth and price growth to calculate organic revenue growth. This helps them to see how much revenue is increasing purely from sales and pricing without other external factors. The third driver of revenue growth is currency effects, which happen when Coca-Cola sells in different countries and exchange rates change. Imagine our farmer sells apples both in the US and in Europe. Last year, they sold apples in Europe for €1 each, and at that time, €1 was worth $1. This year, the euro strengthens and €1 is now worth $1.20. Even though the farmer is still selling apples for the same price in euros, they now make more US dollars per apple. For Coca-Cola, if a foreign currency strengthens against the US dollar, it can increase the value of its international sales when reported in dollars, contributing to revenue growth. The final driver of revenue growth comes from acquisitions and disposals, which are sometimes referred to as structural changes or scope changes. Let's say that our farmer buys additional land which has an orange grove on it. Now they have more products to sell, increasing their total income. That's like Coca-Cola acquiring another company, which adds to its total revenue. But on the other hand, if the farmer sells part of their orchard, they will have fewer apples to sell, reducing their overall revenue. And that's similar to Coca-Cola selling off part of its business, which would lower total sales. Coca-Cola produces a really nice disclosure to show the build-up of their 3% revenue growth across each of the revenue drivers. So let's have a look at this in more detail. Firstly, concentrate sales, and that's their volume growth, and it shows that they sold 2% more product than last year. Now, this is a really important data point, as we can compare this against a competitor's volume growth, such as PepsiCo. If the figure is higher than competitors, it suggests that they're taking market share and strengthening their competitive position. Secondly, price and mix effects. Now, this category includes price growth, but also mix effects. So what on earth are these? Well, these occur when customers change the mix of products that they're buying. If they buy more of the higher priced products and less of the lower priced products, then revenues will increase even if total volumes are unchanged. So it behaves very similarly to a price increase. Now, we can see that price and mix effects added 11% to revenue growth. Wow, that sounds amazing, doesn't it? Well, we do need to remember that Coca-Cola is a global business that exports to lots of countries that had quite high inflation during 2024. So the 11% includes inflationary price increases in those locations. So it's not necessarily something that will recur into the future. However, it's quite reassuring that they've maintained their volume growth despite these price increases. Thirdly, currency effects. Well, these were minus 5%. And at first glance, this sounds terrible as negative. But before we get too concerned, we need to remember that this category reflects currency fluctuations. And during 2024, lots of other currencies weakened against the US dollar, particularly those economies which were experiencing high levels of inflation, where we saw very large price increases. So this isn't something we expect to recur in the future, and actually, it's not too concerning. Finally, acquisition and disposal effects. And these were also negative at minus 4%. And it's negative because Coca-Cola sold some of their bottling operations during 2024. Again, although it's negative, it isn't anything to be concerned about, as it reflects Coca-Cola's current strategy of selling off its bottling operations. So, are all these drivers of revenue growth equally important? Absolutely not. The most important drivers are the most predictive for future revenues. Volume growth is the most important, as it helps us to assess whether the company is gaining market share and therefore whether their strategy is succeeding. Currency effects and structural changes, well, those are the least important, as although they help us to understand what is happening to the business, they aren't as useful for predicting future revenues. The next metric to look at is operating margin. This is operating profit divided by revenue, expressed as a percentage. Now, we can think of this as a conversion ratio. That's the percentage of revenue that is converted into profit each year. A ratio that is higher than the previous year is a strong positive signal to the market, as it shows that revenues are growing more quickly than costs. Equally, a ratio that is higher than competitors is also a strong positive signal, as it suggests that they have a much more efficient cost base than their competitors. Now, Coca-Cola quote is quite different. The full-year operating margin fell to 21.2% from 24.7%, which is bad, whereas full-year comparable operating margin increased to 30% from 29.1%, which is good. So which metric is more important? Well, to understand this, we need to explore the difference between reported and comparable numbers. Coca-Cola provides two sets of margins data, reported margins and comparable margins. But what are they and why do they differ? Well, let's think of it like tracking an athlete's performance. Imagine a runner has just finished a long training run at race pace and their total time was 1 hour and 30 minutes. That seems like a solid time, but does it really reflect their ability and what they expect to achieve in their next race? Well, not necessarily. That time includes everything, maybe a water break, a brief stop to tie their shoe, and maybe even a detour because of a blocked path. While those things happen during the run, they don't actually tell us how fast the runner really is. This is similar to reported margins. They include all income and all expenses, even one-time events like selling assets or costs related to acquisitions. These aren't part of Coca-Cola's normal operations, and they can distort the picture of its true performance. To get a clearer view, we can calculate a cleaned up runtime. We remove the minutes spent tying the shoe and waiting at the detour, so the final time reflects the runner's actual speed under normal conditions. That's comparable margins. They strip away the one-off items to show how well Coca-Cola's core business is really performing. Now, analysts focus on comparable margins because, just like in sports, what really matters is measuring underlying performance. This is a much better indicator of how well they will perform in their next set of results or their next race. So now we know that we need to focus on comparable operating margin in Coca-Cola's results. We can see that it's increased from 29.1% to 30%. Now, when analysts talk about a change in a percentage, they usually refer to it in basis points terms. 1 basis point is 100th of a percent. So Coca-Cola's margin expansion from 29.1% to 30% is a 90 basis point change. Now, the reason we use basis points when we're talking about a change in percentage is to avoid confusion. If we described it as a 0.9% increase in margins, that could either be an uplift in the margin or a percentage change in the margin. By referencing basis points, we know that we need to add 90 basis points to the margin percentage. So, why has Coca-Cola's operating margin increased by 90 basis points? And is this all good news? Well, the press release tells us that there are two main drivers for the increase in margins. Firstly, because strong revenue growth has exceeded inflationary increases in operating costs, and that gives a net boost to margins. And secondly, because they've disposed of some of their bottling operations. But why does that have an impact on margins? Well, if 2023 margins include the bottling operations, and those are generating a lower margin than the rest of the Coca-Cola business, well, then disposing of those operations will have a positive impact on the margins in 2024. Now, both of these impacts on margins will be viewed positively by analysts and investors, as they can be reasonably confident that these higher margins will be maintained by Coca-Cola in the future. The very final metric that we're going to look at for Coca-Cola is earnings per share, which we abbreviate to EPS. And it's calculated as the profit generated for shareholders divided by the number of shares in the company. Now, this metric is keenly watched by shareholders as it effectively tells them how much profit has been generated for each share that they own, irrespective of whether Coca-Cola has issued new shares or repurchased shares during the year. Now, a positive trend in EPS is particularly important as a forward indicator that dividends might increase. If EPS is growing steadily each year, it makes it more likely that dividends will be maintained or increased in the future. And this is particularly important for a company like Coca-Cola, which is one of the most reliable dividend-paying companies in the US. It's actually increased its dividend payment every year for the last 62 years. An impressive track record. When looking at Coca-Cola's EPS metrics, we can see they again provide two metrics, that's reported and comparable EPS. Now, as with margins, analysts place much more reliance on the comparable number, so we're looking at comparable EPS here because it gives a much better underlying performance analysis. Now, we can see that Coca-Cola's comparable EPS increased by 7% in 2024, reflecting really strong revenue growth and, of course, margin expansion. That's definitely a positive for investors, but what about the market? Did the share price rise strongly in response to this information? Well, to fully answer this question, we need to explore a different EPS data point, which isn't provided in the press release, and instead which reflects the expectations of the market. I'm referring, of course, to consensus EPS. Analysts from across the street produce forecasts for Coca-Cola's results each year, with the most critical and widely tracked data point being their EPS forecasts. Now, although analysts' EPS expectations aren't publicly available, they are collected by data aggregators like Bloomberg and FactSet, who then publish the average values to the market, and these are referred to as consensus EPS. Now, consensus EPS is hugely important as it's a guide to what the market is expecting in the upcoming results. Different data aggregators do source their information from different firms, so consensus EPS will differ slightly from one data provider to another. Now, my data source is FactSet, and it shows me that just before Coca-Cola's results were published, consensus EPS for 2024 was $2.85, which is slightly below their published comparable EPS of $2.88. Now, when a company publishes results which are above expectations, this is a beat. And when they're below the expectations, this is a miss. And we can see that Coca-Cola results provided a small but not insignificant beat, which would be viewed very positively by the market. And assuming that there's no other negative information in the results, should provide some upwards momentum to the share price. In fact, when we look at the market reaction to Coca-Cola's results, we can indeed see a positive impact on the share price. And we now know why this is. So that's all you need to demonstrate that you're a pro at results analysis during an interview or during an internship. If you enjoyed this video, please make sure to give us a thumbs up and subscribe so you don't miss out on our latest content covering all things finance and careers.